Hello and a warm welcome into the program. Great to have your company. We have a rip-roarer of a session ahead for you in the next couple of hours. Content and some to really napalm you with. Direct to the desk, Greg McKenna, Chief Market Strategist, Axie Trader, contributing editor at Business Insider. Technical Trades, looking at CBA and MND today on that measure. Commodities Corner, eye on ore, the price of the red metal rising above $52 US. So watching with great interest as it goes back into a very sweet spot. ASIC versus the big four banks, been a big talking point, and we drill down into it. London Calling, Steve Keen, debunking economics author. And the second part, if you missed it last week on the housing bubble, well, we'll get to grips with what the catalyst will be down under for the price correction. And then look at that one live for you with Jim Rogers, pulling no punches on the 100% probability of a recession in the United States inside a year call, why he's joined a local gold and iron ore play, and what's happening inside central banks and what will happen to the greenback. Don't believe the jobs data, says Jim. So don't say you weren't warned. You heard it here first in that regard. But bring to my show the panel, Pete McGuire joining the program today, CEO of xm.com/au. He's with me on my right, and Scott Phillips from the Motley Fool. Gentlemen, welcome to you both. Let's just sort of open it up to discussion. Don't look at me. Go big picture, wide angle if you can, to get everyone into the program. Pete, impressions. We came in today, we've got that US jobs story still swirling. You know, do you buy the numbers?
Well, I think you have to buy the numbers to some extent. I'm not going to go out there like Jim is at the present time. I believe the numbers. I'm also conscious that we're in it's been an upward tick now for many, many years as far as strong numbers. The growth of the US engine certainly hasn't slowed down in any fashion. May have had a little bit of a correction in recent months, but still a long way north of where it was in 2009. We're 6 years to nearly the day from the low. I think it was about the 9th of March 09. Have a look at that time. S&P 670, have a look today. So you can't deny the numbers 7 years on, and that's where we're at.
So are you kind of calling out a wealth effect just by dint of S&P levels? Because is that Main Street, does that talk to Main Street in Middle America? Or what we are seeing on a bigger picture front tells you that that stops and starts at the gates of Wall Street. It doesn't go beyond it in real terms for the real economy. I mean, look at wage growth.
Wage growth, that's another side. I mean,
there's $5 trillion, and what's happened to wage growth?
Exactly. Very, very slow, and if not negative. Inflation is at a record lows. We're looking at interest rates globally at some nations actually negative. So if you're looking at wage growth, I understand better than anyone, my age, that your wages haven't gone up, and it's getting tougher. The only satisfaction, I think, we've got cheap energy prices, and there's a little bit of a boost.
Scott, I mean, again, you know, the spectre of wildcard candidates grabbing market share in a race to the White House wouldn't have happened if everything that we'd been led to believe was true, that there would be a realisable, recognisable trickle-down.
I think that's exactly the problem, Carson. We've seen, look, I think the US economy is fundamentally improving, but at no way near the pace that the market would suggest, nowhere near the pace that corporate profits would suggest, because fundamentally there's still an imbalance at the economic level in the US. Jobs growth has returned, but wages growth hasn't. We haven't seen the same degree of the share of the spoils, if you like, of that recovery between capital and labour. It's the old story. This is still the biggest challenge in the US economy right now, and it's why growth is at a very fundamental physical level much weaker than it otherwise might have been, is there's not enough money going into the pockets of those who'd otherwise be spending that cash. In other words, the individual low income, particularly consumers, who would simply take the money and spend it straight out again. That hasn't happened here to any significant degree, but in the US even less, and that's the big challenge right now, is the US consumer isn't having enough money coming in to help boost that economic recovery. Yes, it's happening, and it's happening at a reasonable pace. Housing construction is up. The amount of vacant housing is down. There is absolutely fundamental improvement and strengthening the US economy. But if you look at the broader story, it's still a question of, you know, when does that strength come back into the base? And to your point, that's exactly the sort of dissatisfaction that's seeing Bernie Sanders and Donald Trump being potential candidates, if not candidate presumptive in the case of the Republicans.
Yeah. So true. And there is so much dissatisfaction across family base. Two members of the family are working, father and mother, and still having a lot of issues trying to fund any form of savings or, of course, for their own retirement. So people are very much of the mindset now, I think, in their 40s and 50s that they'll be working certainly into their late 60s, if not 70s, and are we seeing the 80-year-old worker entering the workplace? So I think you've just got to reignite your career always and be on the front foot to understand that it's a long road ahead. And I think it's going to be many, many years until we see wage growth, and we're seeing that in Australia, and certainly when you look at Europe and those other nations, it's fairly bleak ahead.
Let's bring in Greg McKenna. He's our Director of the Desk guest, Chief Market Strategist, Axie Trader, contributing editor at Business Insider. He's live via Skype for you from Melbourne today. So, Greg, in light of all of that, we are seeing a rally in resources. We are still seeing sluggish Chinese growth. We've even seen a movement away from a fixed objective on that measure coming out of the central government's latest powwow. That would speak to you to what? What would that tell you?
I thought it was a really interesting move. What China's trying to do, or at least Beijing, is trying to signal to the provinces and all the guys and gals over there that put the data together and report back from businesses and that kind of thing, they don't need to fudge the numbers anymore. And I think that's the key message to me, is that China's on this reform process. They're keen about reform. Just like when they set a ban on a currency, they're going to let growth slip down to 6.5%. Then next year we'll get another lower number. But the key message was, an internal message, is stop making up the numbers because you're ruining our credibility. So that, for me, was the big message that I got out of the MPC over the weekend.
But how will international investors, quarter on quarter, handle what could be undershoots on projections? Because, I mean, this is going to be an aggregate figure that they finally then either parade or try to bury. If it's the latter, I mean, even before we get to the final assessment, what will the gyrations be like? Are we expecting more volatility?
Yeah, exactly right. International investors won't take it very well. We've got trade data in China tomorrow, which is going to be very important. You see whether it's non-farm payrolls, might be beat by 10,000, or Australian GDP might beat by 0.1 or something like that. Markets are attuned to react to minute differentials in what actually prints and what is expected. So I think there's two issues here. One is China's trying to signal internally that it's doing the right thing, but that's not going to stop the gyrations we're going to see in markets from Chinese data as that slowdown becomes or continues to become evident in the data.
All right. Now, to that end, the rally we've seen in iron ore in particular, can you begin to fathom this? Can you see a link? And if so, what is the link?
Well, I'm a trader, first and foremost, Carson. So for me, a 40% retracement is kind of a garden variety retracement. Now, that might sound like a big number, but any of the traders out there watching will know about Fibonacci numbers, and 38.2% is roughly what you might call a boring garden variety retracement. The Aussie ASX at the moment, it's not far off. It's 38.2% retracement from the low. So for me, the iron ore, whether it's iron ore, crude, copper, Fortescue Metals, anything, BHP, all these markets are recovering from acute pessimism. I think what the rally tells us is that what we saw in January and early February was ridiculous, but that doesn't mean that these levels we've got now are necessarily any better. And I wonder about the sustainability with, the Fed having to deal with an economy that's got core inflation at the same level as it had pre-GFC.
Greg, Scott Phillips here from The Motley Fool. I wonder to what degree that pessimism you talk about is actually just the reality of the market. We all know, of course, the big mining boom. We know of the excess supply and the fundamentally weak demand relative to the growth in supply. Is this not more than just a technical story? Is this not a rebasing of reality when it comes to the iron ore price, and potentially meaning there is more to go than just the usual technical retracement?
Yeah, I hope so. I think that the reality was that we did, whether it was crude at $26 or the low in iron ore, we factored in all the bad news. We front-loaded all the bad news in the same way that a bull market, and a bubble factors in all the good news. And so, yeah, I think you're right. I think, this could go further. What I meant was that this is a normal bounce, and so now it's for the bulls and for the global economy to support the next move. We need some data and some reality to underpin the move from taking this from a 40% gain to a 50% gain or a 60% gain. The hard yards start now.
Greg, Peter McGuire, just a quick one. When you think about where the crude market, it absolutely hammered from 90 to 26, 27. We're having a good lift up, as you know. You've seen that the hedgies are out of the short positions. There's all of a sudden a renewed sense of, I think, bullishness. Do you think it's going to peter out, give it, say, another couple of weeks? We've had that strong run-up post-China and certainly, the Lunar New Year, all of those pushes. Do you think we're going to run out of steam at 38, 39?
38.39 is my trading target, Pete. As for where we run out of steam, I think that, if you look at what Moody's said about more defaults in the oil and industry in the US, that's going to take production out of the market. We're going to see production taken out of the market. My view would be that over a 6, 9, 12-month period, we head back towards 45, 50, as opposed to crash down to 20. I think that the price is fixing some, fundamental supply issues that we had in the market, and that everybody got caught short by the route that took it to $26 in such a short space of time in 2006. That's cleared the decks, and so with a volatile kind of bottom, I think that the bias is probably a little bit higher. That's going to be interesting for inflation.
Sure. Do you think we're going to whipsaw between now and the next 12 months? It's not going to be, plain sailing just north. Do you think we're going to see that movement up and down and those wild gyrations continue?
Plenty of trading opportunities. We'll definitely be whipsawing. I think we'll be moving up and down. We'll be ebbing and flowing with what the Saudis say, what the Iranians say, those kind of things. We'll be still hanging on the Baker Hughes rig count, all these kind of things. But I thought it was really interesting last week that crude rallied, even though we had a massive build in inventory. That was a sign that either the market is still recovering from its structural short, or there is some actual real changes in production coming through.
Yeah, absolutely.
Scott, you get a sense the market's made its mind up on that one? Because, it's a big looming, it's still unanswered question. Yeah. Everyone was scratching their heads. It doesn't make sense otherwise on a fundamental play. I'm
genuinely, like I said, I don't know what the market thinks right now, relative to where the price have been over the last couple of weeks, other than the general return of some optimism after 2 months of pretty much unbroken pessimism. Maybe there's a sense of the bargain hunters are finally out and getting amongst it. The oil price, the iron ore price, are still significantly above the marginal cost of production. There's nothing to keep them there other than optimism about the future, and optimism, I'm talking about price here, that hopefully somehow maybe there'll be either enough demand come on stream or enough supply come off stream. None of those seems reasonably likely to me. I can't see the fundamental basis for that optimism, quite frankly. I'm not a bear, generally speaking, and I'm certainly not bearish. I wouldn't be going short these two commodities, but gee, I wouldn't be buying them at the current level, given that fundamental reality of what the demand story looks like, which is growing but weakish. The supply side, which is massive, still in massive growth. There's still a lot more coming on. When the iron ore price, lots more being dug out of the ground every day. Oil, there's still so much of it in the ground available at cheap prices that it really requires OPEC to be able to pull the reins back in across the range and say, guys, enough is enough. Stop the supply. But how do you keep the Venezuelans, the Russians, the US shale guys in track?
And you kind of did the Freudian slip if you did bring iron ore into the story, because Greg McKenna, we haven't really discussed the role that EM and debt is playing in all of this. That is to say, some of these emerging markets, the likes of the Brazilians principally, who have almost an obligation, not almost, but do have an obligation to keep the production wheels turning over in overdrive in order to satisfy those funding outstanding loans, correct? To roll them over through some activity.
Absolutely they do. We saw the Brazilian GDP last week. It was terrible. Even just basic economics says that you're supposed to continue to produce in your factory until marginal revenue equals marginal cost. The Brazilians, the Venezuelans, all these guys, whether it's iron ore or it's crude, they need to pump it out. The Saudis do as well. So it really is a balance. But I guess from a crude point of view, different from iron ore, that we're closer to balance eventually than we are with iron ore. And I think that it's a good point that was made that, we've got so much coming on. Roy Hill's coming on board. We haven't really seen a lot of the other producers taken out of the market yet, and so you're still going to have that imbalance. And I'm not that keen after a 40% rally to be jumping on board to take it much higher.
That's probably the key issue, Carsten, is just that there is a situation where ordinarily at this part of the cycle you would have seen a lot of iron ore supply come off stream. It hasn't yet. They're still absolutely hanging on by their fingernails. That's the capitulation we're looking for.
Yep.
Well, is it going to happen?
Well,
when you think about all the capex and all of those big miners, they need to just keep on producing and producing. And they're a little bit, I think, like the Saudis. They're happy at $2 and $3. They can pull it out of the ground for that sort of price. The BHPs, Rios, and Vale. Do they just try and swap a market and just say, right, we're going to capture this? We're maintaining our supply. We're maintaining those strong relationships we have with China and so on. It's a way to do business. I mean, have a look what OPEC did. Have a look what the Saudis did with crude. I think it's a very similar mindset. That's strategy.
OK, well, we're about to lose the line and we've got to go to a break, but I'm just wondering, final thought, Greg, why would you own energy stocks?
I wouldn't at the moment.
You wouldn't? Still clear?
I would be out. If I bought them at 26, 27, like my system suggested, I'd be out now, and I'd just be happy to sit and wait for the next buying opportunity.
Thank you, Greg. As always,
my
appreciate
pleasure.
it. Axie Trader, Chief Market Strategist and contributing editor of Business Insider there, Greg McKenna, my panel of Pete McGuire, and, of course, Scott Phillips. No doubt about it, Scott. You're with us for the next couple of hours. We will take a break. Coming up, the dust settling across the market. Volumes for you unmasked after this. Welcome back. It's kind of almost, it's so parochial, isn't it, when you think of what is going on around the world, to come back to that little old number, but it does mean a lot for us, inevitably. That is where the sort of the centre of the world begins and finishes from 10 till 4 every day. We have got a 1% pop in the 200, as well as the broader all odds. So they actually tracked each other. Identical percentage rises. Not often that you see that.
Very rare.
Just a kind of just a little snapshot in time. Remember it. Remember that. And today, for what it is, Tony Farner from Patterson's Securities is live in our Sydney CBD studio. Just, Tony, welcome. I mean, on that measure, a reminder, amidst everything else, amidst all the conjecture on multiple continents, we are still in bear market territory, correct?
That's correct.
How much have we got to go? Are you keeping a tracker as to when we actually exit that position?
No, I'll leave that one for the technical guys and the like. But for me, it is definitely a bounce. I guess the thing as a fundamental analyst is to work out whether it's a sucker bounce or there's a degree of reality attached to it. And I think it's a little bit of the latter across many of the sectors, not all the sectors.
Now, when you say not all, who are you most sceptical of?
I'm sceptical in terms of the bounces we're seeing in the materials and the energy side. Very good bounces today, and we know the reason why. We saw the prices move in the US and Europe on Friday. We caught up with that, and of course over the weekend the Chinese People's Conference come out and said we're going to deliver 6.5%, 7% growth. That's all good. We're going to do it with a lot more stimulus and more debt. That's all fine as well, but in the middle of that demand side of things, we've got to see genuine growth going forward. And of course as well then there's the supply debate. What's out there for people to buy to start with?
OK, let's talk about a specific move, the specific stock today. APA Group, the pipeline operator, losing some ground, not a huge measure, down about 0.25%. Moody's has come out off the back of this acquisition. Now the bid for EPX to say, look, it's not negative from any future cash flow. I mean, they are funding it partly through debt capital markets and partly through cash. What's your view on this?
Oh, look, I think it's just an addition to the catalogue. It is a little bit expensive, you'd have to say, but the Moomba to Sydney line is, I guess, a positive development for them in terms of usage going forward on the basis of New South Wales struggling at this stage and on a go-forward basis to get gas supplies. So, yeah, I can see the logic in it. Obviously, the EPW guys are happy about it. They've said we'll accept it, want to see the independent experts report, and we'll go from there. But at this stage, yes, shareholders, please take up the offer.
Because EPW didn't exactly take off for the races today. I mean, even that, rise for it, 0.3% was an underperform. Scott, what's your perspective?
I think it's a good result for Ethane Pipeline, and realistically, APA manage this asset. They provide the maintenance for this asset. Effectively, it's not exactly a captured asset, but gee, it's close, and it makes some sense for that to be up inside the APA business. You might as well say, look, we're doing everything else for it. Might as well own the asset, take out the cost, take out the duplication. There's more value in it being owned by APA than being listed on the market independently. That's, I think, why we've seen a bit up in the price. The question, of course, for investors is, is APA paying too much for this asset? This is a relatively fixed asset with a relatively knowable capacity. So it's a pretty simple, it's almost the old DCF, the pointing heads, you get the calculators out and work it out end to end and say, is it worth it or not? APA decided it's worth it. I think it's a very full price on it. There's a lot of upside left for APA after this. Now, I might be still proven wrong, but it's a much better deal, I think, for the ethane pipeline unit holders than for APA holders themselves.
Thoughts on this? Kind of this is gas, but this is really sort of an internal story, right? We're not talking here about going
macro
beyond borders. Yeah. So it's a hard one. I mean, as they say, fully valued probably at these levels, maybe reflecting in that a slight fall on the shares. Well, I mean, Tony, back on you then. If we go inside, what was it, Regis today? No, not Regis, REG today.
Regis Healthcare,
yeah, it is Regis Healthcare. So about a 0.2% gain. Again, this talks to you about what? The aging population, that dynamic exhibiting itself. Are you liking this? Are you liking this JV?
Well, I can see the logic in it. The problem for Regis and all these guys, it's quite segmented component area, healthcare and the aged healthcare side. So they're playing the amalgamation type game. But the issue for me is they're paying not too cheap a price for this, and it indicates to me perhaps a little bit as well. Analysts has been talking about this for a while. Regis is struggling to grow organically to the extent they want to. So they're pressing the button B, and the button B is we'll buy something that's already out there and get it to our standard and make some money that way.
And there is a capex commitment inside that story today of about 5 mil. I mean, that's not a dramatic.
No, it's not too bad, Carson. They've got a hard road to hoe. This is the hardest way to aggregate business and make money. You're not buying at a private multiple in a public market, like say a G8 Education that gets to buy cheap and then listed at a full margin. You're not getting a business that you can easily scale. It's not like you can tuck these things into anything else and say, therefore I'm going to extract a whole lot of cost savings from it, a la an ethane pipeline. You're kind of stuck in this situation where scale matters to Regis. It gives them a bit of buying power, a bit of branding power, a bit of fractionalisation of head office costs. There is some benefit, but these are just individual centres. The way you improve it is, as Tony's already mentioned, try and bring them up to some sort of higher standard of efficiency, of effectiveness. Try and increase prices where you can. It's a very hard way to make money. Now, again, as Tony's mentioned, it's plan B, right? So they had to do something. They've decided to do this, rather try and grow organically, but that's the challenge. The opportunity they have, I guess, to some degree, is they've got land. They've got a land bank as part of this, and that development land might be worth more to them if they can utilise the capital, as you mentioned, build that over time. And you're right, there is definitely a generational and a demographic swing. As that continues, Regis will like the land, they'll like the ability to enlarge these properties. That might be enough, but it's a tough way to make money.
Okay. A final thought as well, and let's just bring it back on you, Tony. The banks today, out in front, and yet we've got ASIC knocking on the door. We've got perception of further imposts looming. Do you see justification in this rally?
Well, in the context of still reasonable growth in our economy and no blowout and bad debts, yeah, I certainly see the thematic there, particularly for people who are income conscious. In the Australian side of things, it is one of the key areas where people can go, get that fully franked dividend that they desire. And if profitability is going to stay up and capital demand is going to get too out of hand, and internationally that's starting to wind back a bit, I still see scope for dividends to be steady to perhaps a bit higher in some of the banks going forward, and that pleases that income end of town.
Is anyone going to beg to differ around the table on this? Seems like you're kind of person non grata if you beg to differ on that story, right?
Sure. Yeah, look, the bank story has been an interesting one. There's plenty still to go. We've got plenty of different economic views out there in terms of what's going to happen and where and to who. I think there's plenty of different opinion out there. There's going to be some people not buying drinks for quite a while at the end of this story, either the Bulls or the Bears. Plenty, Commonwealth Bank came out with a multi-page presentation to say everything's okay. You've got others saying, Jim Rogers, 100% chance of recession. Steve Keen out there saying the house price bubble is still to burst. Someone's going to, not going to be.
Someone's going to be right.
Exactly.
Someone's going to have their visa revoked. All right. Thank you very much to both of you. To you, Tony. We'll talk to you soon. Have a good week.
Okay, see you soon.
Tony Farnham from Patterson's coming up after the break. And yes.
And just one thought.
Briefly,
we were talking
yes,
about natural gas there and gas prices.
Yes.
They're at their lowest level in more than 10 years. So that just gives you some sort of an idea as far as energy and what the reality of the market is. So you put your mind back. It's a race to the bottom.
Quite. I mean, and supplying multiple continents: Russia, the United States. Now us, the Saudi Arabia of the APAC region. I mean, you wear that badge with now some disappointment, not pride. When we come back after the break, though, we switch, we pivot into jobs. Because, I mean, if you're in that sector, again, the spectre of maybe thanks very much, nice knowing you looms. We've got those job ads in Feb at a 4-month low, detailing you the release next. Time for the real economy in focus now. The number of job ads for February falling to the lowest level in 4 months. This is the ANZ Job Ads Survey. It's found internet and newspaper listings down 1.25% in Feb compared to a 0.9% rise the previous month. Job ads also off 8.25% on the same time a year ago, with ANZ's chief economist Warren Hogan saying while the slump may partly be blamed on business caution amid what is global market volatility, the trend growth of job ads has been declining for 6 months. That indicates hiring is slowing. Stephen Roberts is chief economist, Alexander Funds Management. He's live for you, joining the discussion on this one. So, Stephen, remarkably, even today, there were other economists in this marketplace, admittedly from offshore. I'm thinking Saxo Bank calling out that one. They are calling rate rises here. On these numbers today, that seems awfully optimistic.
I think it would be awfully optimistic because when you look at those data we had today and you look at the pattern of employment growth over the last few months, yes, we did have those 2 very strong months going back to October and November, but we did have a fade on employment. In fact, they actually fell in December and January. We won't get the next monthly reading for another week yet, but it will be very interesting to see whether there's any remaining strength in that, because I'm sure it was partly people's feelings that their jobs were secure that gave us that really strong lift running through household consumption, which gave us the surprise, upside surprise on GDP in Q3 and Q4.
And that was the point. The upside surprise leads you to a point where you might well characterise it as, is this as good as it gets? You have bigger picture constrained economic growth. We know this, it's sub-trend. So those numbers of it in themselves have a finite trajectory, do they not?
Yes, certainly. And so what we saw running through the second half of 2015, we're all trying to work out why it was that the household sector was so confident about spending and running down their savings ratio. But it probably came down to household wealth, which was actually strongly rising through the middle part of 2015 into the third quarter. And of course, that's started to fade since. And we had things like job security, and depending on what the data shows, that may not be quite what it was either as we go ahead. And we have the quasi-tax cut from lower petrol prices. And one thing I think we can be fairly certain of is we won't get quite the same size of fall again coming through, because we'd need that to give the same sort of benefit again to the household sector.
Why won't we get it again?
I think it's unlikely that you would see petrol prices coming off another 20-25 cents a litre from here.
Stephen, this is Scott Phillips here. Is there not enough of the longer-term benefit of that? Is, to some degree, petrol prices are a slow burn. It puts money in people's pockets week after week after week. If it becomes a new normal, is that not enough to, I guess, instill a feeling of confidence? You know, the Americans talk about, you know, gas under $4 a gallon being the deciding point when it comes to elections. Is there not a story of, you know, $1, $1.10, $1.20, depending on where you are in the country, a litre here, being enough to simply put that confidence back that you can find the extra 20, 30 bucks a week, and it does change consumer behaviour somewhat permanently, or at least, you know, for the foreseeable future?
I think if we were to stay down in the 90 cents a litre, where we've been parts of Sydney over recent times, that would certainly help to a degree, but after a while it tends to fade, the effect of that, and you'd need it to be drifting down further into the 80 cents a litre, mid 80 cents a litre and probably lower to get a similar sort of impact. And what you certainly don't want is the petrol price to actually edge up and start to rise again. And remembering those other 2 factors as well, and that's household wealth, where, you know, over the last 6 months we've all come to the realisation that returns from financial assets and from housing look as if they're going to be rather more modest than they've been for quite some time as we look out over the next year or two. And it's that security of jobs. Now, if jobs suddenly surge again and we get a great deal of confidence that you know, jobs are secure, then you know, that could help to keep consumer spending running pretty strongly, together with whatever petrol price effect we've got. But I just had my doubt whether we're going to get quite the same configuration of 3 things boosting consumer sentiment, making households feel better, as we did through that second half of 2015.
So it all comes down to a reading from ANZ, the March release on March the 9th. and the last read was 101.3. These are levels, after all. These are fairly artificial constructs, but are you calling out that we'll hold above the 100 mark or maybe slide below it?
I don't know, because these are very hard things to call.
Yeah.
So consumer sentiment on a month-to-month basis is peculiarly difficult to call. It's usually after the events, when you've seen 1 or 2 months' worth, and depending on how the direction's shifting, that's when you can say, oh, maybe there's some impact running through from here. But if I was pushed, I'd say I think we're likely to get a little bit of drift off the 101 level over the course of the next couple of months.
It's kind of... It's always rather difficult to take that release in this particular week, and on the same day we're going to be rewinding the tape to January to getting housing finance data. We're all over the shop. Why are we not consistent month to month with, for goodness sake, data that speaks to the month that's just been? Why are we rewinding 2 months, going back 1 month, back 3 months? I mean, hang on, what is going on?
And then revisions.
Yeah, I mean, and then revisions, quite. So, again, is there a need for this to be so complex, Stephen?
Well, this comes down to Australian Bureau of Statistics for some of the official data, and of course they are under the pump in terms of their funding. And so, if anything, there's been even more drift.
I mean, you probably were saying that from all the time that you've been having hot dinners, Stephen, haven't you?
Oh, absolutely. It's very hard to look at where the economy is going out of a rear vision mirror.
Mr. Rogers in about 40 minutes will add some value to that conversation.
This is right. He will beg to differ on the US data, but we won't lead you down that pathway, Stephen.
Quite frankly, Carson, this is you're exactly right. This is, we're in the 21st century, the internet age, and yet we're waiting 2 and 3 months to pull together some information. It just strikes me as crazy. The one thing I would say, by the way, is that we don't necessarily, particularly as investors, have to be led by each individual data point for we need to respond and react to everything. So it is the trend that matters far more than the data point. But to have to wait 2 months for data, everything's electronic. The information they're capturing is in somebody's database somewhere for some purpose.
Jerry knew those retail numbers, weeks before the ABS. He was crowing about them, Stephen. Of it in itself, that's almost kind of, it begs the question, so much for a mole inside the ABS. I mean, when the retail chiefs themselves can trumpet it, you're kind of caught with your pants down, aren't you, ABS?
Well, you are and you aren't, because let's go back to December. If we listen to what the retail chiefs were saying about December, everybody thought that was going to be a really good month. Retail sales data that came out weren't. It was actually flat. There was a little bit of an improvement came through the month of January. So sometimes the anecdotal evidence that we get doesn't quite relate to the way in which the ABS very painstakingly goes through their data, and they are very, very good at what they do. But to be very good at what you do, it does take a little bit of time.
And a bit of money, Stephen. I think it's also fair to say the ABS not exactly the highest funded agency in the country, and probably more than most deserves a few extra dollars to try and get that data back in shape.
In fact, they've actually been restricted on funding over recent years. It's the story of budget cuts has largely been one where the ABS has, it's only a small amount of spending in the scheme of things, but more often than not they've had money taken away from them.
Okay, your views as well, just on the China day. So let's jump over to that economy, because we had a previous guest saying, Greg McKenna, he was welcoming this move towards a sort of a fungible 6.5% to 7% growth target, saying, look, if anything, it proves that they've acknowledged the error of their ways in the past, that this will prevent a fudge in the future. What do you think?
It makes perfect sense. You can't have a precise point forecast for GDP and build expectations in the market around that. It's very, very difficult, and particularly for an economy which is in transition, a positive one. They're trying to move towards services, they're trying to move towards retail sales. But in the past, when they were getting those huge growth rates, much of it was because capital investment spending by the private sector was just racing along and producing more than half of GDP growth. That always had to change at some point. And so we've been through that change. We're still going through that change to some degree. But there is a discrete lurch down, both in the amount of growth, can't be above 10% year on year anymore, but also there has to be a little bit of uncertainty when you're going through a big transition of growth drivers, where it makes perfect sense to have something of a range there.
I've got a view on ECB to finish it all off, because if anything, the risk of a further knock to the inflation trend, in other words, deflation, very much a live concern. How do they attempt to square this one this week?
There's a few things, aren't there? Some of the data's improved a little bit in Europe, but inflation obviously fell back, the negative sign on the front of it. And also there's been the guidance from the ECB, which has been March is a live meeting of sorts. We're going to review things, and the talk from Mario Draghi middle of February that we'll do whatever it takes to put at least a firm base underneath our banks. And so there is an expectation that they should do something at this meeting. But heaven knows what, because pushing interest rates further into negative territory isn't exactly helpful as far as banks are concerned, particularly when the yield curve is very, very flat as well. So it does make life very, very difficult for banks.
So is this just in Europe in particular, maybe even worldwide, is this really the key challenge of our age for central bankers, to try and instill enough confidence back into consumers, back into businesses, to make that difference, to get inflation moving, to get economic activity moving? It seems like there's not enough negative interest rates in the world that will solve this particular problem without causing more issues, and it's just the consumers and businesses who are simply not out there spending that big confidence with the capital C we're looking for. Is that really what this is all about? Is that really what we're looking for? Is that the only thing potentially that'll actually solve the problem?
Yeah, we need a lot more confidence amongst businesses to invest. Now, we're going through some transition there too, towards more services oriented, away from goods, and so there's not going to be quite as much investment spending as there's been in the past. But we do need the household sector to be confident enough to spend, and spend relatively freely. And to do that, you need that reflected in financial markets as well. And amongst those, you need some expectation that inflation will be there at some point, a modest amount of it at some point in the future, and you need that reflected in the yield curve, and you need those yield curves to steepen somewhat, so longer term interest rates are higher than short rates.
All right, another
And wage growth.
Well, yeah, as if you needed reminding. It's twin impost on both sides of the Atlantic. Thank you both. Well, thank you principally Stephen, Chief Economist at Alexander Funds Management, as our contributing editor there on that discussion. Let's take a break. When we come back, though, we've got so much to tell you about, including the technical part of the discussion, Combank and Monadelphous. Haven't heard from that stock for a while, but we will be looking at the technical moves on it after this break. Let's talk technicals. Gary Burton, FP Markets, as he does this time every week. He's live from our Sydney CBD studio. Gary, welcome into the program.
Thank you.
Let's first off just drill down into the Combank charts, making headlines, not for all the right reasons necessarily of late, but you're seeing what developing?
Well, there's a lot of news around the banks at the moment for various reasons, both good and bad. A lot of people called the end of the banks a couple of weeks ago, and now we've seen a very, very strong bid across all of the banks. And Commonwealth Bank was quite interesting because it had a very strong head and shoulder top pattern in several months ago, which has failed to meet the price target. Since then, on the chart, we can see that there's a double bottom being formed. A lot of people talking about this the last couple of weeks. Very solid solid support at $70. What concerns me the most is on the current move. We can see that the volume at the bottom is considerably lower than the last bottom area. Now, it should be higher in these types of patterns. So I think the upside may be limited here, probably back into the $84, $85 area.
And then what? When we say that, are we implying that is the maximum upside range? And
yes.
then what? You can brace for how big a fall, generally speaking, when it hits those tops?
Yeah, what it really needs is a follow through with buyers, and it would be hard to justify buying the banks against all of their headwinds rather than in this oversold condition. So we've got a general oversold condition, we've got a nice support level on the stock, but I think there's limited upside because of the limited volume on the current move.
Switching into Monadelphous now, because this was once a darling play, and I just wanted to sort of get your views on where it's travelled in the last, say, 12 months.
Yeah.
And where it's signalling it's likely to head.
Yeah, well, Monadelphous, with all the engineering construction companies, have had a really terrible time over the last 2 years, as everyone's talked about, including myself. And we've seen Monadelphous now form. This is a weekly chart we've got up. Monadelphous inverse head and shoulders pattern, very strong pattern in a reversal scenario. the higher low on the right-hand side and increased volume on this shoulder as well. Now this stock set the same type of basing pattern back in January, February in 2015, and you might see a note there that it's failed to take out the high back at that time. Since then the stock has moved lower. We've now got this inverse pattern in here, and we have taken out the high this week, and I think this is looking very, very interesting. It's the same type of recovery you'll see in Worley Parsons and the same type of recovery you'll see in Braitkin.
So they tend to move in clusters.
Sorry, I missed that.
Well, I'm just saying that these stocks tend to move in clusters just by dint of the business they operate in.
Well, there seems to be a very strong change of sentiment across this whole sector at the moment, and it's showing up in all of the related stocks in the area. So it's quite interesting from a technical perspective now that we've really got you can take your pick now.
Seems on these companies too, Carsten, this is very much a story of the oil and gas sector and where the prices go. We talked about commodities earlier in the program. I'm sure we'll do it later in the program as well. This is a story of these three companies being exposed to the recovery in those prices. If that recovery continues, if more work is done, this is investors effectively, I'll say betting, quite frankly, on that recovery continuing, on more work being done. If there's more work done, there's more jobs for the people who are trying to get it. Conversely, if there's no more new projects, as those old projects roll off, and we're still seeing the end of some of those LNG projects in particular, as they roll off, there's simply no work for those guys who are there. So the market, by the way, expecting Monadelphous' earnings to fall over the next 3 years, year after year after year. The share price is actually moving somewhere different. I think we're just seeing that combination right now of, is there enough in the oil price to see a recovery, or are we going to see further downsides if and when the new oil contracts don't come to pass, if the new production, capacity, more importantly, doesn't come to pass simply because it's not needed by the world at these high prices.
Is there any kind of strategic logic in further M&A? You talk the Worleys of this world and the Monadelphous as separate entities, but why not just bulk up? Why not?
I'm pretty bearish on service companies, people-based companies acquiring other companies, taking on debt to do it. So you think about if your assets walk in and out every day, you're buying someone else's assets, you're walking in and out every day. All you're really doing is buying the contract flow, and so if that contract flow is likely to be smaller rather than larger, there's every chance the company you're buying is going to have less business a year from now or 2 years from now than it does today as well. In certain circumstances, if you're very good and quite frankly very lucky, you can do some good business bulking up, and it does set you up nicely for the next boom. But if you get that wrong, you're simply buying another albatross to hang around your neck. You've already got one. That's probably enough.
Heaven forbid, on that logic, you would be very sceptical of media M&A for the very same reason.
There's a little bit of content. There's a little bit of other things. For example, the law M&A, that sort of stuff is always questionable for the same reasons. Media, you got a little bit of content, you got some distribution. It's a little bit different, not so different by the way, but pure consulting businesses, IT services business, mining services businesses, they're exactly the wrong sort of business to be taking on debt to make M&A activity happen.
Gary, we need absolutely. Gary, we need almost like a constant camera on you, because you were reacting during that. Come in on it.
Yeah, look, I don't disagree with the comments. The market's telling us that there's a higher low in the price at the moment. It has had a breakout, has taken out the high. Volume is good on the breakout. So this particular pattern has taken 6 to 8 months to form. Wow. It's not an overnight sensation. It's not an overnight short cover. Monadelphous has about $1 billion worth of work in the pipeline at the moment, and the market certainly, after a $29 million write-down, 29% write-down, I should say, last year, I think the market's probably factoring in the worst that is now behind them and looking for a little bit of growth.
So some clear blue water in the store, which would be welcome, because heaven forbid, this was travelling at a yearly high of 13.1 March of last year, so almost on the anniversary, and we're currently at 757.
Yeah.
So that shows you the level of the washout.
Oh, well, indeed, and it went below that. It went to 532.
Yep.
And it's nadir in December. Okay, Gary, thanking you. Appreciate it. As always, from FP Markets. Just on that, the market, as Gary was saying, prices again, maybe the worst has passed. Can you make any link between that and a broader crude / materials rebound and link the two together on that basis? Is this like another indicator of sentiment?
The sentiment is exactly the point. This is exactly a sentiment story. That's what's seen the oil price recover. It's what's seen the other commodity prices recover. It's what's seen the mining services companies recover. This is a story which says if oil prices are on the way back, then new activity is probably on the way back, and if that's true, new contracts are on the way back. This is the same story played out different ways.
Raises all boats.
Right. So the commodities up, the producer prices are up, the services prices are up. That'll do okay until the mood turns, and then you're going to see all three fall probably in concert at the same time.
Exactly. And just worth noting as well, and it's a random aside, but we haven't touched on it, and I've just noticed it myself here, a percentage spike of 24% for Fortescue today.
Correct.
and Atlas at 47%.
Yeah.
To your point, or something different?
It's a really important thing. We can't illustrate it well, and I won't try with my hands right now. When the iron ore price moves, it moves up in 3, 4, 5% at a time.
Right.
As that happens, the profitability of these guys, Fortescue to a lesser degree, Atlas absolutely changes dramatically. So you go from Atlas from losing a little bit to making a little bit, or from making a little bit to making significantly more percentage-wise. If Atlas is priced for Armageddon, and all of a sudden the price gets high enough that all of a sudden there's some light, all of a sudden it can make some profit. If you're priced for no profit or for effectively going out of business, and the investors can see a direction, a glint of light, maybe it's a train coming the other way, maybe it's light at the end of the tunnel, but you're seeing that opportunity. If you see that opportunity, that changes the economics of the businesses that mine far more significantly. That's why it's a leveraged play on these commodities, and we're seeing that.
Traders take advantage
I was
of it.
going to say, it also happens to be heavily shorted still.
Sure.
So, I mean, the squeeze can be influenced by what? Anything on as arbitrary as the price action for maybe even Dalian.
Well, look,
what triggers those
but
squeezes?
traders are a unique beast in themselves because they see opportunity and they venture where the traditional, mum and dad will not venture.
Because it's other people's money. That's why they venture.
Well,
with
yes,
it.
but certainly, but there's a lot of retail investors that certainly look at charts, but they do their own fundamental and technical analysis. They see as far as yearly charts, what's happening. They look at seasonality and they see that bounce and they say, well, look, in the last time that we saw the stock go X and it was up, 30 or 40%, what were the undercurrents?
Right.
What were the fundamentals on that? And they mirror it. And you don't, once you start looking at, data over a 20 or 30 year window, it's very, very evident to be able to copy those moves. It's not that difficult. You've just got to do your homework.
I understand, but I mean, also against all of that, and we've been talking about China gathered its leadership together. Front page news today. I mean, you take any headline you like. There's Xi on there, all right, and he's probably there as well in that one. And they haven't done anything markedly to lift up what was the story last week to what is to this week's story. So I don't get the fundamental gear shift.
This is a story of this is a story of, we talk about earnings season. We go through earnings season and we see companies that disappoint and the share prices rise. We see companies that deliver great results, share prices fall. It's all about expectations. We spent 2 months, January and Feb, thinking the sky is falling in China. The fundamental overarching story is China's going to pop. We're all in trouble. Get out of the way before don't get
So
your
the fact that
the
they've presented a united front justifies
and reinstate those 6.5 to 7%. The market's like, oh, thank God it wasn't worse than that.
Yes.
It's exactly the inoculation the market needed to feel good. Exactly.
One man who was not confident about it is Jim Rogers, and he is joining us in the next hour. You won't want to miss this one. Live from Singapore, and for everything we've just been talking about, Jim will have a view, and you better listen to this because he's walked the walk and talked the talk over many decades. He's not a flash in the pan by any stretch of the imagination. That is Pulling No Punches, appointment to view for you, only here on Sky News Business. But my panel will be back. Pete McGuire, CEO of xmoz.com/Australia, and as well we've got Scott Phillips from Motley Fool. Back after this.
Live on Sky News Business, this is Trading Day, The Close.
And it's the second hour. If you just joined us, I've got Scott Phillips from the Motley Fool on deck today, and Pete McGuire, CEO of xm.com/au, at the desk for the whole hour. They've been here for 60 minutes already, and now we're welcoming into the show George Babouris, CIO at Contango Asset Management, live from Melbourne Bureau. Welcome to the new week. George, thoughts and fears as you come into this new week? Are you more kind of optimistic following the weekend that was, or you'd read something, you'd heard a client berating you on something that made you kind of think twice about what's in store this week?
Yeah. Hi, Carson. Somewhere in the middle, I'm afraid. In January, we weren't one of those proponents of a global recession, even though people were trying to price that in with certain sectors. And at the same time, we understand there's global issues and global growth won't run away. There's some global sub-trend growth out there. Central banks need to be more supportive, etc. The Chinese will be in their, obviously, Congress until the 16th of March, releasing systematically some really good jaw-boning statements as well. So we're middle camp. We don't expect there's a global recession. We don't expect there's a hard landing in China. We don't expect there's a recession in any significant top 10 economy in the world. But having said that, sub-trend growth, and you can still find a way to participate in some earnings out there and some upside. So that's basically where we are. So half glass full, but always more optimistic than pessimistic, I suspect.
Will you speak your mind with Jim Rogers, I suppose is the question. Will you put it to him that he's delusional?
Well, yeah, he's bordering on that very quickly, because one statistically should never say 100% of anything with 100% probability that there's a global recession. And part of that is the evidence is non-supportive of that narrative, and that is that, yes, you got growth slowing and the manufacturing sector slowing in North America. However, you need a significant slowdown from that current rate, and even in the services as well as the manufacturing, to impact payroll numbers to therefore warrant a move towards a recession. A recession on the number one economy in the world, Carson, is a significant statement, and it's a very difficult outcome to achieve. Nevertheless, people sit there with their pearls of wisdom to try and explain to everyone why it will happen, but the data just doesn't make that case. Notwithstanding the profit cycle is slowing for obvious reasons for the S&P 500.
That's why he says you're actually looking at the wrong data. He says that's half the problem. You're not following the right money, and that data's wrong. What do you say to that?
Yeah. Well, exactly. Well, let's just dismiss that data on the profit cycle that's slowing anyway, which is talking his book, and have a look at some of the services sector. So is the services sector, which is a growing part of the number one economy in the world, slowing at an increasing rate? No, it's not. Therefore, where does one get to a recessionary scenario within North American national accounts with a bigger part of their economy not contracting at an increasing rate? So that's that narrative there. The other narrative is there is activity going on in that economy that's just simply not conducive to recession. And that can be just rolling stock of trains in North America. Have a look at the data coming from railroad stocks like CSX. It's like there's a handful of stocks in North America you can track. And the flow and movement of goods is still not consistent with a recessionary scenario. So even if you're sympathetic with the Rogers view that the number one economy in the world will go into a recession, which is a big statement in itself, there's a number of different indicators, whether they're from the national accounts or predictive indicators of activity, that just don't warrant towards that statement coming true. So while it's slightly possible, I just think it's highly improbable.
And yeah, just before you come to Scott, I just know that all those factors that you cited are domestic driven. So you've created, as it were, a decoupling construct, as if to say there's no possibility of contagion, or if there is, you haven't allowed for it in that wrap of the US as you see it through 2016.
Now, that's a very convenient pickup, Carson. And 40% of the S&P 500, let's just say those earnings are sensitive to non-US dollar earnings, and that leaves some scope for that not hard landing, so to speak, in the number two economy in the world, and that's China. So given that China won't go into a hard landing as our core premise here, that should also be mildly supportive for 40% of the S&P 500 earnings.
George Scott Phillips.
Good pick-up, Carson.
Yeah. Sorry, George Scott Phillips. Mate, I'm not going to fight Roger's corner for him. He's capable of doing that, and I don't necessarily agree. But what I would say is there is a sense that perhaps it's a consumer-led recession, this one, in terms of, we talked earlier in the program about wages growth not really coming through. It wouldn't take much of a stagnation there for the US consumer to simply go on strike. That may predicate such a downfall, and given the level of debt there, both on consumer and business balance sheets, that there might be a precarious position. Do you put any stock in that it might actually be a consumer-led downturn, if you like, rather than a business-led or S&P-led downturn?
Yes, in part. The very limited upside in wage growth in the developing OECD world in recent years suggests that view, Scott, that you're saying it creates a cap towards a credit growth scenario. And we all know what's going on in the Western world, like even in Australia. Australia is a leading indicator of, and that is you're losing one job on the mine for $200,000 and you're creating 4 jobs for $50,000 in Western Sydney. Unemployment rate holds up, you can service your debt obligations, but it doesn't put you on the front foot towards discretionary spending. But at the same time, that narrative, and you can extrapolate that in North America, the Midwest, West Coast, East Coast, that narrative is not conducive towards the consumer collapsing or credit growth collapsing. That's the point to highlight. So discount stores do well, or Walmart does well over there, or Aldi does very well in South Australia because those jobs are obviously not high paying. But I don't see the downside. It's not a binary outcome. It's not credit growth 10% or credit growth down and I've got to get out of my discretionary stocks. It doesn't fulfil it because there's more people being employed at a lower wage, and that still creates some activity. It's just not robust activity, which creates effectively a floor and obviously limits the upside. So I'm partly trying to say, let's be reasonable here. Why would the number one economy in the world have the consumer go out there in discretionary and lead it into a recession because it puts its money in its pocket? It just won't happen the way people are sort of making that narrative. And when it comes to US housing, it's a different proposition altogether. But the employment cycle is robust in North America. You're just not getting paid much. And that upsets people, and that's probably why Donald Trump's getting some votes.
Yeah.
And maybe that's also factored into the bigger picture recession thing. I mean, you touched on it right there at the end, but if the unthinkable happens, if the black swan moment, because no one can predict this because it's never happened before, but that's not to say it can't, in theory at least, happen, that he would get over the line in defiance of every kind of handbrake that's applied at every stage of this race that remains. Now, if that were the case, could that be a trigger for recession that not enough people have factored in? To you, George.
Yeah, I still think it's highly improbable, and it's a bit of a Mel Brooks comedy here, like the producers here. You're sort of extrapolating that theme here, where bad is good until that bad becomes bad again. But the thing to highlight, comedy aside, I still think there's a bit more sanity out there that won't eventuate. And if that does happen, I think, yes, there will be some problems that will be built in as that process eventuates. It won't be just a shock event with it. But nevertheless, it's an interesting scenario, which I don't think many of us would like to it fulfilled.
It's very nice that when we now switch and we go across the Atlantic from this, I mean, this is all proverbially because we are, I mean, Jim's based in Singapore, we'll be talking to him shortly, but then if you go across the Atlantic from the US into the UK, where we will be speaking to Steve Keen, he comes to us from his living room, which kind of, there's a nice symmetry about this, really, isn't it? Because it all comes back to housing for Steve. And so we do the interview from, the heart of his own home, his castle, as it were. Now, on that measure, his call-out is still quite seductive. And this is that, notwithstanding he got it wrong on the crash last time, the seeds have been sown for it still to happen, even though supply and demand would suggest otherwise. Do you find that compelling from where he sits, George?
Yeah, no, I'm afraid, with all due respect to Stephen Keen, not compelling at all, and I'm afraid Stephen Keen's in a Monty Python skit here, when the castle disappears and I build another one. But after the second time, then I built another one. And he does it for 7 castles, and he's systematically there, I'll build another castle. But it's a perpetual Monty Python scene. Now, Stephen may be right in the fullness of time, and he would have got it right in the 1891-1892 recession. He would have got it right in the 1932 to 1935 deep recession of Australia. He would have got it right coming into the 73 to 75, 81, 82, 91, 92. But a lot of things have happened since then. And you may get median house prices, for example, being flat year on year when you look at it across Australia, which means they're negative in other parts of Australia, like in New South Wales, for a couple of quarters. And that is a reasonable outcome. But there's the recourse nature of loans, the negative gearing scenario, the unemployment rate, the economic robust nature of Australia, the low Aussie dollar, the automatic
population growth.
I'm afraid the highest in the OECD. I'm afraid there's a lot of structural economic variables that a professor of economics should acknowledge that limit the downside. And a burst of a bubble is a minus 40%. To get a minus 40% on the median house price in this economy, you need an unemployment rate of 8 to 10%. And you don't want to own a bank in that scenario. So Stephen, like Monty Python, may get it right in the 7th attempt, but that'll be about basically 2049 when that comes through.
So the highest levels of mortgage debt and household debt in the world, running at 120% of GDP versus 80 in the United States and the rest of the world, that doesn't, to you, flash amber?
No, what it does, it says to me there's really no upside. And the point to highlight is People's house prices are lower than a year ago. They just don't know it. Because when they look at the evening, when they watch Sky Business, they see the All Ords, ASX, mark-to-market, and they see the accountability of that. They saw the minus 10%, the minus 15%, the plus 5%. They see that on a daily basis, the ASX 300, the All Ords. Your house price is much lower. It's probably 20% lower than where you would have got it mid last year, particularly in Sydney. But you don't know about that. That's the thing to highlight. But we're talking about a median postcode house price, statistically, being down 40%. You do the math. It doesn't seem possible unless you've got an unemployment rate north of 8%. Now, notwithstanding, there is an oversupply of high-density housing, and there'll be a lot of apartments that'll be empty, and there's going to be cheap apartments. And all those people that want cheap housing, become European, embrace it, and just move into a house in the sky. You can still do that. The Europeans do it, and they'll be very cheap for you. But we're talking about housing stock or land that won't go up in a year or two ahead. But nevertheless, we're making the case that it won't go down 40% like Professor Stephen Keen's saying. And that's a difference in this discussion. We can't see that scenario happening. But yes, Amber, parts of the housing stock, high rises. A lot of people can't settle with the new changes to the way LVRs from the lending facilities since they bought off the plan 2 years ago. I acknowledge that. Just a lot of cheap apartments in the sky for a lot of Australians to get accustomed to. And how good's that?
Well, if you believe in living in a shoebox is a healthy proposition.
By two.
For mind and body and
By
spirit.
two.
Yeah, all right. Knock the walls down and probably the whole building falls over. Thank you very much. Appreciate it. George Baburis from Contango, CIO. Love to get the panel on this. We're going to take a break. Maybe we'll come back and talk more in just a minute. After this, we'll also go to Bloomberg, live in Hong Kong for a wrap on the regional session that was. Welcome back. Well, a bit of a mixed picture to come out of the regional market action today. Let's cross to Hong Kong, and Bloomberg's Sherian is live for you. Warm welcome. That unwind on the 225 of note, and the Hang Seng as well on the back foot. What are you saying the drivers were today?
Well, there's a lack of clear direction across markets in Asia today because investors just have a lot to digest. We're talking about a rally in oil, better U.S. data. We're also talking about everything that's happening in China as leaders gather for the National People's Congress. So we're seeing Chinese stocks currently surging for a fifth consecutive day, rising 0.3%. That's the longest winning streak in 5 months. Just a few minutes ago, it actually dipped into negative territory for the first time this whole day, but it's currently up 0.3%. The Hang Seng Index unchanged at the moment. A different story for Japan, though. Japanese stocks are falling or fell. They finished already down 0.6%. That's, of course, after capping their best 3 weeks since 2014. We saw a sell-off in the so-called defensive shares. We're talking about power plants. We're talking about also railway stocks that were down. Now, analysts saying that this was a correction as some shares were overbought during the rally. Now, we'll soon see a shift in the BOJ board. So analysts are expecting for the central bank to become more pro-stimulus as a bigger majority becomes more in line with negative rates. BOJ Governor Haruhiko Kuroda just speaking in Tokyo a couple of hours ago saying that it's desirable that FX rates move in a stable manner. And also, just a few minutes ago, the South Korean finance minister came out saying that market instabilities in Japan, China, as well as in oil-producing countries were hurting exports in South Korea, as well as production. And South Korea will announce new measures this month to boost jobs for the youth and also for Korean women. We're seeing that South Korea rose 0.1% at the close. And we'll leave it there for now.
Yeah, one of the few markets to exhibit a degree of upside, and it's just the operative word there is degree. Thank you so much. Appreciate it. Let's talk iron ore. More gumption, more conviction in the drivers there, and you can see that in Fortescue's spike today, some 24% clear. Iron ore price really climbing high as those steel mills have been restocking. The red metal up 1.4% to more than 52 US a tonne. This is the fourth session of gains now. All this coming after a report from Macquarie found expectations of a short-term recovery in the commodity. That said, the latest price hike partly seasonal, mills stocking up on the raw material in the wake of the Lunar New Year break. Peter Strachan is from Strachan Corporate. He's live in our Perth studio for you this afternoon. Focused in on this one and noting, of course, the fact that Fortescue's regained its strength. Are you, though, changing your views on any holding in that particular proposition? How do you like it relative to the majors?
Which one? With
Fortescue.
Fortescue.
Yeah.
Look, Fortescue has been really assiduous in cutting its costs. They're aiming to get their cash costs down to $15 a wet metric tonne, and that's come from, in the sort of $52 a tonne level. So they're really pushing themselves right back down into that low-cost area. So, I mean, there's still higher costs than Rio Tinto and BHP for sure, but they've done a fantastic job of getting their costs down.
So this is the C1 cost, is it?
Yeah, that's their cash cost. So that doesn't include the royalties nor the insurance and freight to the market. And remember also that they're producing a lower grade product. So they get about a 10 or 12% discount to those $53 a tonne that we're talking about for the current high grade material.
So the question was always been, what were they doing at 52 a tonne in the first place? If they could squeeze them down to 15, that was an awfully profligate, or was that just the necessary relative blowout that you have in early production phase of any new operation?
I mean, there's a bit of both, because when you're developing your project, you're not really focusing so much on costs. You're just focusing on getting the tonnes out the door. And remember, when they were developing this project, the price of iron ore was $140 a tonne, so it didn't matter what it cost. They just get more tonnes out there. Now that they're designing for production, and also they're changing their mining profile, and what they've done is to reduce their waste to ore ratio, so the amount of tonnes they have to move to deliver a tonne of iron ore, and so they've reduced that. And the question is, how long can they do that? They might be able to do that for 2 or 3 years, but then they'll have to start to move more waste material and the costs will go up. So, they've got a 2 or 3 year time frame where they can keep those costs quite low.
Peter, Scott Phillips, curious as to, obviously a lot of talk about Fortescue and good moves today. The smaller guys, the Atlases of the world and others, trying to do something similar, I'm sure, keep the grade up, try and get as much as they can per move tonne. How long have they got to go before they really start to feel the pain, or is this $50 a tonne price enough to keep their heads above water?
Well, I mean, as you say, I think they're working for the banks, these guys at the moment. They really are just trying to pay their debts down, pay their interest, make sure they're doing that. Atlas is effectively having a in situ administration. They're turning their debt into equity. They're talking to their people they owe money to and saying, would you accept some shares and we'll give you a cut in the profit. So, they're doing everything they can to stay with heads above water. But, what's happening in China, as you were saying before, is that we're seeing a short-term move there on iron ore. Now, whether that's a long-term, certainly there's a bit of a boost of steel production and going on in China. Whether that's enough to keep this price above $50 a tonne, everyone's been wrong forecasting iron ore over the last 2 years, so I'm not going to join that gang. But I think it's still a bit hard to call the bottom of the cycle in iron ore. But certainly in base metals and certainly gold and in oil, we're seeing some very strong signs that we've reached the bottom in those commodities.
So this
copper, of course.
Well, that's an interesting one, because that, of course, is influenced as well by even the housing data in the US, for instance, which we often overlook. It's still the world's largest consumer, right?
Yeah.
On that measure. But just on this talk, Peter, of the steel mills in China, a few months back, if you go back in time just before Christmas, there was a lot of chatter about the overcapacity, or at least the need to wind down a lot of these mills. They were being kept open artificially by the Chinese government. Where on most metrics, and you talk about cost out, the numbers just don't add up. But they were doing it to keep jobs rock solid in the face of fundamentals. What's changed there?
So that's what's happening. I mean, the jobs in the steel industry were largely welfare. I mean, a lot of those steel mills were not making money, but they've now had, of course, this big push now to reduce their pollution. And the big polluters in China are steel production, cement production and power generation.
Yep.
So they're really focusing on the better, higher grade ores and really focusing on, you know, getting the just consolidating in amongst the more modern steel mills, the ones that have lower pollution. So that way they'll be rationalising the steel industry slowly, and that'll be some of the smaller, less efficient, higher polluting mills actually will close down slowly.
Thoughts on gold? Meanwhile, you touched on it briefly. We've seen an uplift on COMEX about 12.50 an ounce. But from everything we've been saying, I mean, OK, the greenback was weakening off. So does it come back to that story fundamentally? A pushback on what's the Fed doing next? Therefore, what will the greenback do? Hence, where to for value on bullion?
Yeah, well, I mean, gold over time basically holds its value. I mean, it's not something that goes up or down in real terms. And so I think that's what's going to continue. I mean, obviously, it's come up to $250 an ounce just in the last 3 or 4 months, Australian dollar terms, to trade at over 1,700 Aussie dollars an ounce. And I think that's probably fair value. I mean, we could well see it up another $100 an ounce in the short term. And certainly, while ever there's a concern about the Chinese yuan, I mean, people talking about devaluation of the Chinese currency, that's what's putting a bit of pressure onto the gold price. And of course, you know, just talking about Chinese money coming into Australian property, it's the same sort of thing. People are just trying to get yuan out of China because they fear that that currency is going to devalue, so they might as well buy now. And the same thing could be happening in iron ore, but where they're using the high yuan to buy iron ore now.
Okay.
There have been great strategic buys when you think about it over the last couple of months, you know, and you're now at 50, but they're at 40. Have a look at those, you know, again, China, you've got to give them praise. I've seen it time and time again, year after year. They keep on buying at record low prices, and they buy, you know, extraordinary amounts.
OK, whether we can say
iron ore, yeah.
Absolutely.
But not of housing here. That's another topic. But thank you, Peter. Peter Strachan Corporate. So much to get through, and we will therefore move on and take a short break. But on the other side of it, as promised, rumbles of a downturn in the United States economy. Experts are saying an economic recession could be in the works in the next 12 months. Specifically, Jim Rogers out with this call. He's joining us next. Welcome. The corporate watchdog confirming it is targeting a number of major banks in its probe into the rigging of interest rates. Well, in a brief statement to the media, ASIC confirming that its investigation is broad and involves, quote, a number of major banks. This coming as hot on the heels of ASIC's prosecution of ANZ for rigging the bank-built swap rates, which ANZ says it will vigorously defend. Meanwhile, the law firm Morris Blackburn's said to be investigating ANZ's conduct, preparing a potential class action lawsuit. ANZ had a separate run-in with ASIC. Meanwhile, the lenders pay penalties totaling more than $200,000 for breaching responsible lending laws when offering overdrafts to customers. Well, this fine relating to a mail-out between November 2014 and Jan of the next year, offering a group of existing customers an overdraft facility with a limit of either $500 or $1,000. The corporate watchdogs found ANZ failed to give customers the option to select a different overdrawn amounts, therefore didn't make reasonable inquiries about the credit limit a customer requires. And so that one goes. Looking at the banking stocks today, Water of a Duck's back, all of that. It's been said, David Ellis, head of financial equity research at Morningstar, that ASIC is a eunuch in a whorehouse right now. What's your view on that one, in terms of its effectiveness or otherwise?
Well, there was some indication during 2015 that ASIC was undertaking this investigation. So it wasn't necessarily a surprise on Friday when it was announced that they were commencing legal action against ANZ. I'm a little bit surprised that ANZ have taken the stance that they have and are vigorously defending their position. I would assume they have very strong and robust legal grounds for making that decision, because I think in the long term, if it turns out that ASIC is indeed correct and that ANZ are at fault, well then I think that'd be very, very, very embarrassing for the bank.
And does that also go some way towards just the damages, say the spectre of some kind of an exemplary component which would seek to deter financial institutions from publicising their perspective ahead of any final finding?
Yes, and it's not just ANZ. I mean, obviously ASIC has been investigating, I think it's 12 banks, and of course the four major banks are the key ones. So I think there'll be further announcements on the other three major banks following ANZ's situation.
Compare and contrast the LIBOR scandal, the London rigging episodes, with what we are seeing here. Do we begin to enter the realms of problem rogue behaviour that the Europeans were engaged in?
Well, I can't make any specific comment on actions or behaviour of individuals within the four major banks in particular.
But what about risk then, David? What about a kind of a climate of the ability to kind of do your bread and butter, which is to push the boat out and to take those necessary risks, to have those animal spirits at play versus the inability to monitor, or at least be seen to be on top of what was quite a lax environment in retrospect?
Well, I mean, that's the very nature of a trading room. I mean, that's what across the whole investment banking and banking sector. That's why traders are can be so successful, because they are prepared to take the risks. We've seen many times in many countries, in many jurisdictions, where this has gone horribly wrong, and there's been massive amounts of losses and massive amounts of fines. Yeah. I think globally, since the GFC, not just because of rate rigging, but globally, fines for the big European and US banks are up over $250 billion so far in the last 8 or 9 years. And that's a massive amount.
And you've got things like a chief risk officer, and to be able to practically monitor this in real time as it happens, one individual, for instance, or maybe a small team, versus a whole floor that's engaged in it.
Yes, it's very, very difficult, and this is nothing new. This is, I mean, I used to work in banks 10, 15 years ago, and it was a big problem then, and it obviously is a bigger problem now. I mean, particularly as trading has become faster, the amounts of the dollar value of amounts of trades have become bigger. So it is very hard to manage the risks.
David, isn't this just simply a case of banks being too big to succeed, if you like, too big to fail, but aren't they now just such complex beasts that actually do present existential damage or existential risk to the Australian economy, to the global economy, when there is that scenario, when someone in the risk chair says, well, they'll never say this, of course, out loud, but basically it's just like, I don't know what's going on, I hope everything's okay, I put some plans in place, maybe everything's okay. Doesn't that strike at the very heart of what these banks are supposed to do, and the risk they still pose, even after the GFC, those lessons we're supposed to have learned, to the global economy?
Sure. Well, for the Australian banks, particularly the four major Australian banks, I think the situation's better than what you've just described, and of course I hope it's better, but I'm sure it is. What we saw globally, particularly in the big European and big US banks and the big UK banks, was they just got so big and so diverse and across so many different regions and markets that it just got so complex that management couldn't keep on top of it. The four major Australian banks are a different animal; they're a different beast. They operate in a much smaller market. They've got less exotic and less product, less derivative trading and those sorts of things, less principal trading. So the four major banks can make and have made such large amounts of money from their domestic commercial banking operations that they haven't had to push the envelope too hard in their investment banking activities.
And the nature of these chats that were coming to light last week, the publication of these incredibly graphic accounts in real time, but only now poured over after the event to identify what would seem to be underhand activity. how can that be judged a success in terms of risk and risk profiling of activity and sanctioning of it?
Yes, I mean, it obviously looks terrible in hindsight. It looks bad in hindsight. It gets back to your earlier question about how effective the risk management function within a large bank is, and that's been an ongoing issue for many, many years and will continue to be an issue going forward.
Okay, well, we say it, but then it's as if to say we have acknowledged it, but what, we just expect it now? You've effectively said, David, you're expecting this problem to continue for many years. So what is the merit of having an ASIC inquiry into this?
Well, I can't comment on behalf of ASIC, but of course, they obviously consider or thought there was an issue here, and that's their conclusion. It looks like at this stage.
But it's a damning sort of indictment on where to from here. If you are effectively saying, I'm not putting words in your mouth, you're expecting to see it continue for many, many years.
Well, I'm not talking about this specific example.
No, of course. The climate and the ability to do this.
Yes, I mean, what we've seen, we've seen a lot of restructuring and a lot of legislation in the US and Europe and the UK to try and limit the risk and try and reduce the risk. They're talking about in some of the European and US markets, splitting up the big global banks, moving away their investment banking businesses away from their commercial banking businesses, as a way to try and limit the damage that these activities can cause. We're not going to see that in Australia because, as I said earlier, the investment banking businesses of these 4 major banks in Australia, fortunately, are not large enough, across the total pie as far as the business goes. So I think you'll see a lot tighter regulation, tighter risk management, and more involvement probably from the boards to try and get on top of this going forward.
And compliance. Yeah, okay.
Very much so. I mean, boards, like it or not, directors have a duty and a care and a responsibility. Yes. They can now be held to account. There is no, I didn't know, or ignorance from any board member, or certainly banks. And when you're thinking about responsible managers, you're thinking about key persons on AFSLs, all banks have those, and then compliance teams on risk management. It goes up the chain. There's nowhere to hide. And so in turn, it's going to be interesting how it plays out and whether ASIC do become very, very centred and take the whole situation and turn it upside down.
Clearly they did hide, and clearly they did do it. I mean, these transcripts are after the event. So it was sanctioned, it happened, it went through the system, people made their millions on the side, and homes were renovated and cars were purchased. Full stop.
Yep.
No equivocation. David?
Well, yes, that's very definite. What I can say is the 4 major banks have spent massive amounts of money and time and effort on regulatory, on complying to regulatory change. And risk management is one of those regulatory focuses. So it's not as if they've been standing back and doing nothing. I want to make that clear. They spend a massive amount of money each year on complying with regulatory issues. Obviously, in this example, it hasn't worked. But I'm sure there'll be, going forward, there'll be a lot more effort, a lot more time, a lot more time and money spent on improving compliance and completing operating risk management.
I wish I was that positive. I think
David doesn't even sound like he believes it. I mean, he's saying like he's reading a script from. I mean, apologies, David. I know you're very sincere at the best of times, so there's no indictment on you there. But there's a perception from what you've just said that's not quite hitting home.
You don't even need to necessarily think there's anything nefarious going on, although we can rule it in and out at different times. Okay. ANZ have had their issues. Commonwealth Bank right now is going through 2 separate issues in terms of regulation, compliance, risk. These types of issues we're talking about, this is on insurance policy sales, not the sorts of things that either can hamstring an entire financial economy and or bring some of that economy down. I'm not predicting doom. I'm just saying there is way insufficient coverage on the banks themselves and by ASIC on these sorts of issues.
And from there we will wrap it. We've got to wrap it. But I want to thank David Levis from Morningstar. The panel continuing. We will take a break, hoping to cross to Jim Rogers on the other side of it. Welcome back to the show. We've got about 15 minutes left in play. We're going to try and squeeze in a couple of special guests for you. But in the meantime, as we work towards those, just some thoughts on, where you are sitting with the washout from, say, the Fed from last week. Are you saying that the dollar moves are effectively now just down to further doubt, further unease over Janet's next move? Because the window of opportunity you were saying in the past on really moving on these rates, arguably passing, and now we're sort of almost playing get through the door very quickly, if at all, before you can't raise rates anymore.
Well, that's right. I mean, that December rate rise, there are a lot of analysts said that we should have seen it in May of last year as our first rate rise. We should have probably been at our second by the end of the year if you were going to have it. Now it's certainly a different situation. Political structure in the States, what's happening there. We're looking at negative rates as far as what Japan and certainly the Eurozones, what's moving forward as far as those two nations, and then where does the States play? So, currency-wise, is the US dollar, it's had a very, very strong run-up. We all understand that. We've seen a crash as far as commodity pricing. This year, I think it's going to be a very wild whipsaw as far as commodities and certainly currency. So it's very, very hard to say we're going to see another rate rise in the next couple of months.
I mean, you talked about how the Chinese are very, very assiduous with the way they are buying at the levels that they're at. Do you sort of see this complicating the story, that they are buying ultimately in US dollars?
Yeah, this is still the, I think, unanswered question in terms of the Chinese economy. We know it's going to be massively important to the rest of the world, but there's a manufacturing, there's a traded goods element, and there's straight out of currency element, as you say, and the degree of which they still carry an amazing amount of debt in US Treasuries. There is effectively this two-party dance going on, and neither can afford to let the other go more than a certain distance for each of their own sake. If anything, the US, probably not by design, probably just by effect, have ended up with this dance partner who simply is as invested in the success of the US as China is, and vice versa. So you've got this scenario where the US doesn't want to let go, China doesn't want to let go. Ironically, that gives us a great amount of global stability because both are invested heavily in each other's success.
And so, even these runs that we saw today, you'd say it's too soon to really call a shift beyond what is still a bear market.
Gee, I think you have to. I think it's a really... The Australian market is a difficult beast because we've got banks and miners, they make up more than half of the market. So where they go goes the rest of the market. I wouldn't at all be surprised to see commodities continue to struggle as long as the fundamentals of supply and demand hold out. Where speculation, expectation starts to roll into the numbers, you are going to see some movement. So oil can't justify today's price on its fundamentals, neither can iron ore. That's a straight-out reality. It can only stay there for as long as people are prepared to pay that much to take the obligations off someone else's hands.
Pete, the same with copper or different?
Copper moved up. I mean, when you think about it, copper's up, the best part of 35% from its lows of $4,000, now at $5,200 a metric tonne. It's been swept up, of course, with crude oil and with iron ore. So a lot of them just, the tide rose and all of those boats rose with it. So where it runs at the moment, I think that some of these markets are probably getting to a point of exhaustion to the upside, and there'll probably be some form of consolidation. And the big but is, from a trader's perspective, I think that whipsawing action will remain whilst you've got so many linkages. When you look at where gold is, you look at the currency side of it and how that interplays into it all, there's a lot of uncertainty, and which in turn creates opportunity for traders.
And do you sort of ultimately see, even if the doomsday scenario that Jim Rogers is putting out there is correct, and you do go into a recession, the idea would be that the greenback somehow does become your safe harbour. So does that begin to actually, as a thesis, make it less attractive to be in the commodity space? Far more expensive.
Well, it is far more expensive. Look, I think when you look at Jim's argument, certainly he's going back for 200 years, and I've read, copious amounts over many, many decades of his writings. When you think of, that long-term forecast as far as US and the recession every 6 to 8 approximate years, he's saying that it's got to a point in time now that it's saying it's about that sort of number. We should see a recession over the next 12 to whatever months, and his argument is saying, growth is going to be toppy. It'll get to a point that you'll see retraction, and in turn, a recession is around the corner. is he going to be right? Is he going to be wrong? I'm not sure. But all I do know that we've had a very, very strong run-up as far as equity markets over and unemployment. You look at what the numbers are in the States, that strong push-up since 2009, 7 years ago, really to the lows, and no one can argue as far as the recovery.
Is that half the problem, that you've got to factor in these probabilities, because as night follows day, as you were saying before, a bubble will eventually burst, for instance.
Yeah. If it is a bubble, and this is the key challenge, is by its very definition, a bubble must burst, otherwise it's not a bubble. And so the problem is you don't know that till after the fact. There is expensive, there is overvalued, there is horribly overvalued, and there's a bubble. And just because you get to expensive or even overvalued or even very overvalued doesn't give you that sense of now next step must be a bubble, therefore there must be a burst, therefore things must go horribly badly. Look at the Australian economy itself over the last 5 or 7 years. Despite the mining bust, and we can all agree that's a bust in terms of the commodity prices and share prices, the Australian economy's managed very impressively considering that grief. I mean, we had enough drag on the economy through that mining slowdown to suck the wind out of almost any other economy. The fact we've kept going is most parts luck, good governance by the central bank, and probably some more luck, quite frankly. This is a situation, the non-mining economy's grown just enough to keep us in a good place or a decent place. Below trend growth is a great result. If you'd offered us that, if you'd said, look, the iron ore price is going to crash from 140 to 40, the oil price is going to go from 100 and something to 25, you can get out of it with sub-trend growth of 2%, we would have rushed the doors, signed up as quickly as we could, and said, thank God we got away with that. We're now in this position, we're saying, well, it's not very good, we could have better. Of course we could always have better, but gee, it's a bit ungrateful considering where we are. We are still the Goldilocks economy, for better or worse.
Except you cannot then overlay the housing story, which, again, is a Steve Keen thesis. You cannot get to the next chapter of that whilst you are at sub-trend growth. By definition, these are not sub-trend prices that we're seeing. I mean, and we're seeing household debt relative to GDP at world high levels. Now, that only makes sense if you have, does it not?
Wage growth, full employment, but I don't see that at the moment.
No. So if you don't see those two characteristics, it's a problem.
Well, Peter, you made the point off air earlier that just because things are overvalued doesn't mean they're necessarily going to crash. Property that's being sold for expensive prices today can still be selling for the same price in 10 years' time.
Exactly.
Does that make it a bubble in hindsight? No, by definition, it makes it overvalued. So, if my place is worth 25% more than it should be, then maybe it crashes back and maybe it ends up being cheaper, or maybe it just sits at that point for another 5, 7, 10 years. Again, maybe a nice escape, but maybe we can't get away with it. Maybe there will be a crash in the meantime. But just because it's expensive, just because it's overvalued, and I would personally argue that most Australian property, at least in Sydney and Melbourne, is overvalued, that doesn't necessitate a crash coming next. You can effectively grow your way out of it, like we grow out. That's what the global governments are trying to do: grow their way out of these economic malaises of debt and deficit by effectively creating inflation. Now, if we can get the same sort of approach, but we end up with flat prices rather than inflating prices, and they go nowhere for a period of time, that'll be a nice escape, it'll be a lucky escape, but it might just avoid that crash.
Let's bring in Steve Keen. He's in London. He's live via Skype. Steve, welcome to the show. Listening to all of that, if you were able to detect any of it, it's early in the morning, and I know, thank you for getting up for us.
Yeah.
This idea, your second wave of the housing bubble bursting, you say, yes, it hasn't burst yet, but it all comes down, to a continuation on these private debt levels rolling over. What's gonna stop them in their tracks and pop the bubble?
Just the fact that there's simply, at some point, and I don't need to specify, but there's got to be some maximum level of debt that the economy is going to carry, mortgage debt or private debt, and we are streaming towards that, and that's why house prices are rising, because mortgage debt's accelerating at something of the order of 2 or 3% of GDP per annum. And that acceleration is what causes rising house prices, as I explain in today's article. And to me, it lets me actually clarify, is there a bubble or is there not a bubble? To me, a bubble is blown up by accelerating housing debt. We've got accelerating housing debt in spades. When that starts to slow down, as it must do, because nothing can accelerate forever, then house prices start tumbling.
And you've got no sense on timing, but I mean, how has it been able to go to the level that it's gone to now? 120% of GDP. Mortgage and household debt.
Courtesy of totally brainless, irresponsible government management by both the government, whichever party's been in power, and the Reserve Bank. And then, Steve,
and then hold that thought, Steve, because then you get HSBC today, and let's bring this up if we can on screen. They are rejoicing in the fact that there's more of that to come. which is on your thesis. Here we are, just to keep the same effective financial conditions settings as delivered and the strong H2 GDP growth performances, the RBA may have to cut further. Thankfully, they've got scope to cut further to keep Australia's great rebalancing act underway. Our central case is another 25 bip cut from the Reserve around mid-year. That's exactly to your point, Steve, that they will keep stoking the flames and the economists will keep rejoicing in it.
Yep. And because they have no understanding of the role of credit in the capitalist economy, which is ridiculous because they're economists and everybody thinks they should understand money. And as I've been saying for some decades now, the mainstream economics dominators is a cult that believes you can model capitalism as a vast system. And they therefore completely ignore the level of private debt while they pump it up at the same time through policies like this. It's got past. I've given up having any politeness about this, if I ever was polite, mate. It is just totally irresponsible. This is like having 19th century doctors putting leeches on you when you have a heart problem.
Come into the discussion, Scott Phillips.
Steve, Scott Phillips, just a quick question for you. I get the point of obviously debt can't escalate forever. That's pretty clear. What is it to your mind that creates that linkage between debt can't keep growing, therefore house prices must crash? Why is it not possible there is a prolonged period of simply stagnation when it comes to prices? What is the mechanism, if you like, or the cause of that collapse after that acceleration effectively ceases?
Well, it's a good question. The relationship is, as I said, explained in the article, the flow of new mortgages is the demand, which is change in mortgage debt. On the other side, you've got the price level times quantity. And you're going to have rising prices. You have to have positive and rising acceleration, or acceleration rising from a dip. When you go to deceleration on a grand scale, that is actually taking demand out of the equation. So in one situation, prices are going to rise. If we're going to get positive inflation on house prices, that's with acceleration and rising acceleration. When you have declining acceleration, you're going to have the pressure is going to be for the price level to fall, and therefore you'll have falling prices. And that's applied in every country, including Australia. This is what people don't realise. That's why I wrote the article today. Every country where this has occurred, there's been accelerating mortgage debt in the bubble up, decelerating in the crash down, and we're just lining ourselves up for a bigger crash, possibly than anybody since Spain.
Okay. On that sobering thought, Steve, it's your new week. Welcome to it on a very bleak note, but still, it's one that's been made with some clarity. Thank you for that this morning via Skype. Our London calling opportunity. I want to thank the panel. Scott Phillips from Motley Fool, as always. Thanking you, Scott. Pete, great to have your contribution. Pete McGuire, CEO of XM.com/AUS. Always value having you, Pete, alongside today.
Thank you, Carsten.
Apologies on Jim Rogers. The technical setup for that meant we're going to have to hold off on it, but we will endeavour later on this week to return to it with Jim in Singapore. For now, stay with us. Lots more after the short break.